Okay, Pred. All right, welcome everybody to Wall Street Reporter's Stock, a live stream for February 2nd, 2021. We have back with us Skylight, Pred, the CEO. Pred, welcome back.
Hey, Jack, glad to be back. Thanks.
Pred, our audience, again, they're looking for those 10x to 100x upside stocks. That's what we're here, to bring them with our live stream. Skylight is definitely, it's had a very good start. Since we began. January for you has been really, I guess, a very busy month. You've had some, acquisitions you've announced. You got the institutional meetings, and today. You have this really important news. I think I would say it's a pivotal announcement about the remote patient monitoring, the rollout of this. So before we get into that, right, and we talk about all the exciting things, the big growth initiatives for 2021. For anybody that's new to the story, tell us what Skylight does in the U.S. Multi-trillion-dollar healthcare market.
Yeah, so Skylight Health, we're a U.S.-focused healthcare services company. We play within the insurable services market and underinsurable market within the U.S. You're right, Jack. It's a multi-trillion-dollar healthcare industry. We're a different story. We're a public platform with the capability to consolidate and acquire today, a 70% fragmented industry in the U.S. that is ripe for consolidation. With significant experience in bringing these kinds of healthcare services together and creating a ton of organic growth and value and a lot of sort of utilization to currently relatively, assets that they can certainly benefit from a lot of structure and capacity and management expertise. It's our goal to generate, a business that can easily hit $1 billion in revenue and plus within today that multi-trillion-dollar healthcare industry. We're playing along the likes of other billion-dollar revenue companies like Oak Street Health and One Medical, and we're quickly executing, and I expect to start to catch up to these companies, in a relatively short period of time.
Pred, I love the Skylight story. In fact, you got me so excited that I hit the desk and the computer started bouncing here. So what I think the key thing is. What's most compelling for investors is that not only you have this big consolidation opportunity, right, which you're executing, and you have a growing pipeline. Every time we speak to you, there's it keeps expanding. Obviously, as the stock is moving up, you have more opportunities. But I think the key takeaway is that you're able to, your real strength is increasing their organic revenue. Really like by factor of. You say 10x, right?
Yep. So, this was tried years ago, right? In the late 90s, companies in the US, public companies were trying to roll up primary care clinics and try and create this network effect and the scale effect. And, it's a well-understood market on the US side, but unfortunately it didn't work. And, a lot of that is right time at the right place. And honestly, today Skylight is at the right time at the right place. We didn't have the technology. We didn't have the funding models. We didn't have the communication. We didn't have the transparency in order to make a model like that work. And, for the last 20 years, we've been doing it successfully and recognize, obviously, the maturation of that industry today. So today, we still have the same type of fractured industry in the US, where over 70% of healthcare practices in primary care are running independent. And there is this huge push to consolidate because the more patients you have, the better your contracts, and ultimately the better the returns from an insurable services model. But there isn't a platform like Skylight today that has the ability to consolidate at our level. We're playing in a unique niche today where there are far few competitors. We're buying assets at very attractive multiples. And to your point, Jack, you can improve costs all day long, but what value can you really bring to these clinics? And you're looking at opportunities where clinics are generating on average of $150 or less per patient per year. And in our models, at minimum, they should be at $1,000 per patient per year. And our Blue Sky takes us over to $10,000 per patient per year. And this is built on a very real replicable model that we have succeeded with in the past. And so today we have the technology, today we have the transparency and we have the management expertise and an active market that is ready to hit reset on the strategy. And Skylight's right there within one of the largest healthcare markets in the world, looking to achieve sort of that next generation of success.
Okay. And really today's, okay, so, you're in how many states right now in the US?
So 15 markets now and soon to be 16.
Okay. So you're gonna be in 16 markets and you have over 100,000 patients.
Over 150,000 patients, actually. Yeah.
150,000. So it's growing. It's
grown. It's grown.
Okay.
Yeah.
You got 150,000 patients. So now today's announcement, the remote patient monitoring, you actually this is started rolling this out, right? So can you explain what that is? Kind of the business model and what that really means for Skylight in terms of revenue opportunity this year.
Yeah. Okay. So we talk about this organic enhancement, this value, which, by the way, this is what investors want to see. This is what institutional investors want to see. Anybody with money can go buy anything they want, but how are you going to build real value? And so this is an example of where real value comes from. So you take hypertension, where today, over 40% of our patient population could potentially benefit from improved services within. The partnership we have at GatherMed was announced a couple of months ago, where we now will offer our patients this remote patient monitoring device supplied by GatherMed. And our nurses and doctors will provide remote monitoring. So patients don't have to travel to take their blood pressure anymore. Everything can be done remotely at home. It communicates via Bluetooth. It's integrated into our technology. And for reviewing and monitoring it, first of all, it allows us to be there for the patients and proactive if we feel like we need to recall the patient or get a hold of them. But for providing that service alone, this one product within a certain category of patient condition falls within potentially a $2,000 a year per patient revenue billable model, where insurance compensates us as an organization monitoring fees annually or monthly, that leads to annually up to $2,000 per patient per year. So just, based on a small subset of patients, even if you take a third of our patients today, that's over 100 million in potential annual revenue just on this product alone. Now, next ask the question.
Hold on. So $100 million in potential revenues, and that's based on a third, based on 50,000 patients.
Based on 50,000 patients, yeah.
You have 50,000 patients. So basically, how many of the whole pool could benefit from the remote patient monitoring?
So we estimate right now it's about 40 to 45%.
Okay.
Yeah.
Okay. And so in other words,
and remember that patient count keeps growing because every time we acquire.
Right.
Correct.
Okay. So this is this is just one example of how you're able to increase revenues, on that patient base. Okay. So it's 100 million. So if you stop, like right now, if the company did not grow anymore, so potentially you could be doing 100 million in revenues with a third of your people. What are the margins on this?
A little over 60%. So quite strong.
Okay. So, that in itself could be worth, $1 billion valuation, based on, more than $1 billion valuation based on, some of the comps in the market out there with, what is it? The Oak Street, the One Medical, Teladoc.
And even that would be less. Like Oak Street and One Medical are trading at 15 to 20 times revenue. So, you're looking at 1.5 to potentially $2 billion at that point if you're using, fair market comps.
Okay. And how many shares? So right now, how many shares are outstanding?
So there's about 175 million shares today.
Okay. So 175. So in theory, just with this initiative alone could be worth $10 a share without anything else.
Just with this initiative alone. But I know you're focusing on this one initiative, but this is an example though, Jack, of let's call it 150 per patient per year on average to 1,000 or more, right? And so, this is one example of a tool. And we've certainly got more that we're working on that, we'll hope to, bring to our patient population soon enough. But if you think about the organic growth within each clinic that we're acquiring, each practice that we organically grow to, that revenue should far surpass just this basis alone. But to your point, yes, one product, one service could generate this much in return. Okay.
So this is pretty compelling. So I mean, just this one initiative. I mean, it's kind of mind-boggling, but really, just this one initiative could be worth $10 a share right now.
It could be, yeah.
So interesting. Okay, so I want to get into some audience questions here because we're getting some good, and that's kind of really the idea here is we want to.
Yeah, absolutely.
One of the questions we had, which is one of the things that actually I wanted to ask you, is Andrew here. Okay. Prad, what has been the feedback from institutional investors you've been meeting with? You started what, I think just in January, right? With the JP Morgan conference, you kind of started going from there.
Yeah, so it's been thanks for the question. So it's been extremely busy, and it's only going to get more through the month of February. So we have been very active, both US and Canada, and doing a lot in the US as well, both through our own sort of roadshows with investors, but also now through some of the larger banks that we've been working with. And the feedback has been pretty much, on point with the same thing we've been hearing so far, which is this is a unique story at a unique time at a very opportunistic moment in US healthcare, where we are going to see more money being spent in primary care and in healthcare to create access for patients at a lower cost. And it's going to be a trend that you're only going to see, now further advanced by a Biden administration. And we're already seeing that today with changes to the Affordable Care Act, for example. So there's certainly a lot of excitement. There's been a lot of demand. And that is the demand that ultimately, we know that today can't participate on an OTC market listing, but is eagerly awaiting, a Nasdaq uplist. And so this is part of sort of the overall strategy to understand the book of demand, figure out sort of who the right institutional players will be. But it's all been nothing but positive. And, I will say also that as much as they appreciate the M&A activity, they really, really like to see how we're going to create organic value within these acquisitions.
Yeah, I mean, okay, so it's very interesting because right now you're meeting with meeting, I guess it's all by
virtual
or whatever, right? So now all these, so essentially you're building kind of this pent up demand because a lot of these guys, like you said, they can't really buy the stock until it's in Nasdaq, right? Especially the bigger institutions, has
Correct.
to be Nasdaq for them. But they get the story. I think one of the things is that you're really like, a lot of these guys, they're looking at the comps. So you're very cheap compared to, like the One Medicals, the Oak Streets. And is there anybody else, like who else is what other peers do you have in the public market right now that are kind of doing something similar? Is there anybody else?
Yeah, so you said two things. So one, direct peers for us in the US market, not really. I mean, you start to talk about sort of the much larger organizations like United Healthcare, but I mean, very different models altogether.
Yeah.
Right? But no one really that plays in our subsector today. And that might change in the near term. We're going to start to see. But here's the other thing, companies like, larger groups, private organizations, whether you think of, larger consolidators like Privia or VillageMD, which are all relatively private organizations today, these companies are going to demand a much higher share price because, they're far ahead in terms of revenue and where they stand today, which creates another really interesting dynamic for Skylight Health, which is, what is it today? I think we're heavily undervalued. We're trading at little over 4 times, forward-looking revenue in terms of our acquisitions that we'll look to close this quarter. Let alone where we were before at 7 to 8 times fair market value, where they were seeing us as cheap. Today it's even cheaper. And so, the way I see this is, and what I'm hearing is, this is only getting more and more attractive. It is a low entry point into a high growth story within a sector of the market that is going to get a ton of attention, both from the markets and from the government in terms of funding. And, I think it's a perfect storm, Jack. And I think that's what we're going to see as we continue to move forward. And that's what we've been doing to be very careful, ensuring we have paved a pathway forward that we know is going to resonate well with, real high quality institutional shareholders.
Yeah, I think one of the catalysts, again, one of the things that we look for, with our kind of next super stocks is, these companies which have, they're addressing, massive multi-billion-dollar opportunities, multiple catalysts, and they're at a key inflection point. So Skylight meets all three of those. So the Nasdaq thing for Skylight specifically I really believe it's going to be one of those catalysts that is really going to move the stock, because again, the U.S. institutions love the healthcare space. They love consolidation stories like yours, especially if you can you can show that you're adding value, as like you're doing with today's announcement, which is going to be once again, all these guys, they're following what you're doing, right? So once they see traction, and so then they can model that out, and that becomes like a an institutional favorite. Everybody piles in, and the thing goes to 100. In theory, it goes to 100. But why not, right? I mean, if you let's talk about the M&A pipeline.
Yeah,
that's the retail audience, our audience. They love hearing about M&A all day long, right? They don't want to know about they just want to know news every day, that cadence of deal flow. So you announced you announced this deal in just a couple of weeks ago that's going to get you to what they're doing. They're doing 20 million revenues right now.
20 million, yeah. So that gets us close to about 45 to 46 million in annual revenue. Yep, and about 10%, 12% in EBITDA. So, we're adding profitable assets. We're leveraging cash and debt to be, the most effective form of acquisition pricing today. I mean, the price was based at 4.5 times EBITDA. So again, we're demonstrating our ability to really kind of find good deal flow here. I think, so I also want to address, Jack, I know part of this question that's come up for me, and I'm sure there may be a question on this call is, what about the Florida acquisition? So we've made 6 acquisition announcements in the last 4 months, 4 have closed. So, I certainly want to let everybody know that there's no concern with regards to Florida closing. In fact, I would say with some relative confidence that, all the checks have been checked off with regards to getting the deal closed. But, now that we're trading on the venture, there's, an additional regulatory approval that needs to come in place. And so there's, I guess, just been with an overarming, amount of demand in terms of their time, a little bit of delay on the exchange approval, which, we expect to receive imminently. And so, we certainly look forward to announcing the closing of Florida, which will certainly add to the continued, trust and execution. What we've announced, we've closed, and we expect to be the same moving forward. But yeah, let's look at M&A, Jack.
This is okay. So this is the moment everybody's been waiting for the last 17 minutes. They want to hear about the pipeline. Then we'll get to some more questions. So yeah, here's what's interesting. Since you began with us, you got on our live streams, everything you've said you've been delivering, right? Which is very important. I mean, so you talked about the M&A pipeline. You've been delivering on the pipeline. So right now, February 2nd, what does your pipeline look like?
Yeah, I mean, look, when I came on 4 months ago, I said we started with 10 million, it grew to 50, it ended the year with 75. And I'd like to give myself room to grow, but let's be honest with you, it's a 200 million plus. And, let me kind of walk you through a really interesting dynamic, Jack, that I'm certainly really excited about, and something that's been continued to demonstrate itself as an opportunity for us. So this large acquisition we made at the $20 million deal that we're buying for 14 or so and change. This is an example of a network acquisition. All right. So it is a multi-location practice that is resourced. It has the management team, and it has a 2 to 3 to 5 year growth plan that is going to look to significantly expand growth on its own. And there are, like this, so many different network players across the US today that I would say this is probably the smallest of the ones I've seen. I mean, we're looking at deals that are 40 million, 50 million, 60 million in revenue. And again, I think that's still scratching the surface. Here's the opportunity. These transactions are typically sponsor backed, right? And so they're not founder anymore. They have VCs, private equity. Now, management wants to run these companies long term, and the sponsors want liquidity. And so eventually they just sell to another private equity group. Well, here's an opportunity. Skylight has a platform today that, unlike others, has the ability to access equity capital through public markets that today nobody else does. It has the ability to incentivize sponsors by providing currency that will see value over time. And it has the ability as operators to let the management teams build and grow their companies. And so we're entering a phase where we are starting to see Skylight not just as a consolidator of independent, smaller sized transactions, which we are, and that still is very much a real target for us, but the ability for us to play within a much larger sandbox where today the only other option for these larger size players is a fixed multiple EBITDA exit to private equity where they may not get the same return long term and it's not aligned with management. So, I am more excited now as this continues to grow. We're going to get access to a stronger market in the US from institutional support, strategic institutional capital, and we are going to be able to start to play within this sandbox. And I'm fully confident in saying that these are some of the deals right now that fit within the pipeline that we're looking at. And so from an M&A perspective, I've just upped my target in terms of what I think we can do over the next 2 to 3 years, just inorganically. And, I know people don't want to hear about organic, but you're talking, 100, 200, 300% return in growth on these companies organically. So, that's how you get to $1 billion quickly.
Okay. So the takeaway is, I think, is that your the size of the deals that you're doing is really increasing. You're about to kind of enter a whole new world, like this kind of like elephant country essentially, which is these $50 million type networks. How many of them are there, do you think, that are in play, so to speak, at any moment?
Thousands. I think there are those that are in play, and I think that those that will come to market as soon as you start to knock on the door. And
they see. Let's say, I'm going to be conservative. I'm going to say Nasdaq. Let's say 6 months. I'm just being conservative. I'm not going to say it's going to be next.
Sure.
These things always take a long time, but let's say it's 6 months from now. So by August, right? So by August, you're a Nasdaq. You have the institutions start coming in. The stock. I'm not going to make projections, but let's say the stock is, you're going to have a lot more growth. You're going to have things are going to be better, I believe, in 6 months, than they are today. So all of a sudden now you're going to have all these private equity firms that have these portfolios. They're going to be looking at you as, this is the vehicle. This is, they can, get these health networks into Skylight. They get shares, and it's a win-win. Here's a question: what do you think you can exit if you do a couple of these deals, right? How many do you think you can do? Let's assuming you're a Nasdaq, right? Let's say you're a Nasdaq today, right? How many of these deals do you think you would be able to do? 50. Let's say the $50 million range.
I think at this point in time, in terms of cadence, we can probably add 3 to 4 deals a year. And that will increase year on year, right? So as you're growing, you're building conditional strength and foundation.
And you have that, and the organic thing kicks in. So it becomes like a what do you call it? A virtuous cycle.
You're building cash flow to fund acquisitions. You're building market share to you're building your valuation to continue to increase on deal size. And you're not biting off more than you can chew. And that's what's truly important to the US institutional investors. How are you going to deliver growth? And so I think this cadence that we've developed for ourselves is very possible. And we're proving it out. And that's that gives me comfort in saying that at least in the near term, that's how much we can move on. I think our biggest challenge is going to be taking on as much opportunity and then closing on as much as we can. And so that's a good problem to have. And my take on that is always, there's ways to strengthen and build a foundation so you can continue to ingest. There's a window of opportunity, and we certainly are going to maximize that window.
Okay. So let's say so let's say 200 million revenues. And I think it's important to emphasize for anybody watching that, hey, essentially you've delivered everything you've promised. So this credibility here. So let's say you exit 2021 at $200 million run rate. There's a probability.
Okay. It's a probability. Yep.
Reasonable?
It's a reasonable probability. Sure.
Okay. So 200 million, right? So really that would be worth, based on peers, $3 billion. Market,
based on an undervalued asset today, just $1 billion on its own. So yeah.
You'd have more shares out, but it could be still. I mean, I still see a path. I see really a path for this to be a $10 stock by the end of
I mean, look, the reality, Jack, is you're buying companies. Let's say you paid 5 to 10, depending on how these resource companies price and trade at. But even if you do, you're buying companies where, let's say, 5 million in EBITDA, 50 million in revenue, 60 million in revenue, and you're buying them for 50 million bucks, right? What's the value to us? Well, for Skylight shareholders, that's worth 300 million to 600 million based on a 5 to 10x multiple, which is still cheaper compared to where the industry peers trade at. So with that level of growth in accretion, if we did nothing else but just acquired all day long, you can see how that growth starts to replicate at a very rapid pace. Now, in the organic growth in there, I think that's where you drive those multiples higher and you start to get that institutional support long term, which helps you get the higher comps, ultimately creating a better value overall in the share price. But just along the opportunities that exist with consolidation in the space and the level of fragmentation, this is like I said, right time, right place, and executing in the right market.
Yeah, so it's. I mean, once this thing is on Nasdaq, I mean, Skylight, it's a phenomenal institutional story. I mean, like we talked about. Okay, so let's address kind of the elephant in the room, which is there is discussion of a potential reverse split in order to get onto Nasdaq. Also, give us what's the story there? Are you going to do it? Why are you doing it? Give us your thinking there.
Yeah. So look, there's no certainty, right? And I guess everyone's looking at what was filed today with regards to the shareholders meeting. They'll be coming up in February to approve up to a 5-to-1. So that's the key. It's up to a 5-to-1. I think what we want to do is to make sure we have all our ducks in a row, so that when it comes time to listing on the Nasdaq, we're not sitting with any bottlenecks that we need to then delay. Timing is everything. The market is extremely hot right now. Deals in our sector are heavily 5 to 6 plus times oversubscribed. There is a lot of institutional demand today that cannot participate, right? So, what we're doing here is just creating the opportunity for helping the process move timely, and that's all it is. It'll come down to two things, Jack. It'll come down to price, and it'll come down to capital structure. Now, there are much smarter people than me helping to steer our capital market ship, and this is not an inexperienced team. I mean, this is the team that took GrowGen from $3 to $46 from the OTC to the Nasdaq. And, this is the team that understands institutional demand and what it means to create the right synergy of investors, post-market support, and what the market will listen to. And for those that don't know GrowGen, it is a consolidation with significant value growth within the retail sector on the US side. And so it has many of the same effects that Skylight has. Skylight speaks to a very similar story within a different sector that today is also receiving a lot of attention. So, we are going to listen to smart money. We are going to take the advice of proven capital markets strategies. And that's what I said in the last call. We will only do it when the foundation is built the right way. And we are taking it step by step. We are doing all the right necessary steps. We are meeting with institutions. We are taking in the book of demand. We are looking at feedback, and we are making deals to continue to build the value of the company until then. And February is going to be a very busy month for us. I mean, we are marketing all of February to continue to expand the story. We have a lot of eyeballs on the stock that I get today cannot play on the story, but all that means is that is a ton of demand on the sidelines just waiting for an uplist to happen. So, take that as you may. But the way I look at this is, it's going to mean that whatever we do to be successful on the Nasdaq is going to be successful for everybody, which includes management that today, are significant shareholders and have continued to, voluntarily extend our own no sells just to show confidence that we are behind what we say. Okay,
so you're behind the GrowGen story.
Sorry, Jack, you cut out on me there. I apologize.
So your key investors, like you're major investors.
I mean, look, GrowGen was one of Merida's top successful picks and success stories, and Merida remains our largest foundational private equity investor, and we have a lot of aligned folks that have seen this work before and are attuned to what makes it work again, right? So we're certainly not following, without any proper guidance. And there's a strategy that's worked for the company until here. But let's also be honest. This is not a public market story without the fundamentals to back it. This is a company that is generating aggressive revenue growth, a lot of organic value over time. It is generating strong positive earnings, and it has the ability to accelerate growth with a broader market access. And that is what is being communicated and understood within the U.S. confines of institutional investors.
Okay, no, so this is it's like when you look at Skylight, I mean, like all the the stars are lining up. I don't know if it's
It really is.
Yeah, it's like everything really. It's like everything is kind of lined up so that once the stock hits Nasdaq, which that's the perfect. That is the perfect market for Sky. I mean, that is for some companies. It's not. It doesn't make a difference if they're a Nasdaq. But for Sky, that's the institutional. That's the platform for health.
It is the answer that everybody is waiting for. That is interested in the story. That understands how much of an buying opportunity this is today, given the valuation of the company comparable to its peers, and given the runway for growth that we have in front of us, right?
So essentially, right now, I mean, based on the comps, the stock. I mean, so one of the catalysts is just that valuation gap closing is 4x. I mean, that's really worth basically $5 a share Canadian. So if in other words, if you were just trading based on the comps, I don't know why you're not trading. I mean, at that 20x, because you're doing all the same things they are. I mean, you're growing at a faster rate than they are. So it's just I think this is a massive opportunity for investors. But okay, so I want to get to a couple more questions. We're running out of time here. But okay, so George is asking, when can you disclose some metrics that demonstrate the uptake SHG's experience? I guess the organic growth is referring to.
Yeah. So with every acquisition, there's always an ingestion time, right? And so typically we kind of look at 3 to 6 months before deals start to get to a point where we can start to implement change, because you want to make sure these clinics, ingest successfully. So, I'd say certainly the second half of this year is going to be where you start to see those numbers probably reflecting. And when we look at organic growth, it's not just on new patient acquisitions. We're buying established practices where the value we're bringing is the enhancement of revenue driven by an existing practice. And so it's how are we enacting change to create more increased visit frequency that will lead to insured billings, that will lead to increased access for other services. So, the organic platform that is driving value growth here is how do you bring a more disciplined approach to an existing practice, which will then result in a better, improved financial outcome for the business itself.
Okay, Pred, let's wrap up. Over this coming month, what other kind of news flow can investors look forward to the next, let's call it 4 to 6 weeks?
Okay, so look, I think we're doing all the things we need to be doing, which is, past 4 months, we've brought some pretty significant acquisitions. We're going to be focusing on closing all of them. So that's number one. We got to stay true to what we announced. And so we've got 2 left, which will be done. And it's a question of just getting them done. So that is going to be our focus, is closing the acquisitions. Number 2, strengthening the foundation. We've added on, a really experienced and U.S. focused centric public markets and operational board member in Grace. We'll be announcing some additional key hires. You could think of this as now Skylight is starting to institutionalize our organizational structure and really bring on that expertise that understands how to run multi-billion-dollar healthcare companies. And so that is going to help create further organic expansion, but also successful ingestion of these acquisitions. So those are things that we'll be working on very aggressively in February, along with communicating and expanding the roadshow and continuing to get more institutional support for the potential Nasdaq uplist. And look, for anyone that wants to hear it, there is a second wave of M&A activity coming. And the first one that was done in the early part of January was just the beginning. And these are bigger deals with more materiality. And there are some smaller transactions there as well that build density. So there are some big, some small, but there is an active pipeline that we're working on. And for anyone that knows sort of the diligence we take on this, we like to do some upfront work to make sure it's a deal we really like and we think will add value. So expect those types of news flows to certainly come to market. And then lastly, we're, like I said, we have a very active market down south, and we are, positioning ourselves to become a leader within the space today that largely doesn't have, a lot of competition. but has very near-term comparables that show sort of the valuation gap on Skylight today to where we could be at. So those are going to be our focuses over the next several weeks.
I just want to highlight this comment from Wahid. He's making a very, very, very good point, which is that, a lot of times reverse splits, they get kind of like a bad rap that, because he's making the point that, hey, the reverse split is only bad. We've seen it when companies are forced to do it so they don't get delisted. So it's those stocks that are going, they're going in that kind of ski slope when they're, going below $1, then they're forced to do it. So they have problems, which, is not related, but when it does to get then it works out. Especially, I think, especially do the reverse split as you're doing it you're going like into strength, so that you have, again, this is, everything's kicking in, revenues are exploding. Then the market understands that there is a reason why you want to, again, tighten up the capital structure and to appeal to those institutions. So it's, I don't think that's going to be an issue. Let's see here. We got he's making up. Okay, so IPA did a 5-to-1. Yeah. So it works. It works out.
Yeah, and look, Jack, for the audience to hear, it's not just about the share price, right? I mean, you're right. This has nothing to do with share price. This has to do with, it has to do with share price, sure, but it has to do with the right structure, right? You're going to tighten the float. You're following the recipe of successful stories with the right set of institutional backing behind the story. Institutions drive valuations on Nasdaq, and you're doing it with a ton of catalysts and to come, news flow that's going to continue to just keep demonstrating success. Sure, $5 to $10 is great. I want the GrowGen $3 to $46 to more, and I want that for the company, and I want that for our shareholders. And that's what we want to deliver here. And we're focused on a much larger growth plan here that I think will focus on continued execution like we've always done, but for our shareholders, seeing that aggressive growth along the way.
Prad, usually I ask at the end, the famous question, top 3 reasons to buy. But I think we've already mentioned 100. I mean, we've pretty said it all. So this is fantastic. Prad, okay, thank you again for updating the audience, and hopefully we're going to have you back on this month, maybe several times, right? If you have some news.
Yeah. Look, well, we're going to have more news certainly coming out, and look forward to to coming back on and unpacking that news flow.
Prad, thank you again.
Thanks, Jack.
Okay, let's get ready for our next presenter. That was fantastic stuff going on. Again, this is all the right catalysts. Everything happening right now. Here is another stock that is doing all the right things. FansUnite. Let's get ready for FansUnite. Just stand by. We're going to bring in Scott. Okay. All right. Scott, you there?
Hello.
Okay.
Yeah.
Scott. All right. We're ready to start with you. We got a full house. They want to know what's happening with FansUnite. So, okay, welcome everybody to Wall Street Reporter's next Super Stock live stream for February 2nd, 2021. We are back with FansUnite, FANS on the CSC/FUNFF over the counter. Scott Burton, the CEO. Scott, welcome to the program.
Thanks, Jack.
Scott, actually, I need you to adjust. Can you adjust the monitors? I want you more in the frame. I want to get more of you because we're going to have a different height. We got to get. Yeah, perfect. Okay, yeah, perfect. Yeah, I'm going to make this. I'll put you so we're okay. Maybe okay. So now, maybe lift it up. I want us to be like an eye level visually, so it makes it easy for me. Okay, perfect.
Is that better?
Scott, you look like $1 billion there.
Thanks. I feel like it.
Fantastic. So listen, Scott, there's a lot of great things happening in the space you're in. One of the things, that we look for, with the next super stock program is, again, companies that not only are, do they have, the billion-dollar market opportunities, the multiple catalysts, inflection point, but also they're in the right theme. So you get these massive tailwinds. The theme that you're in is sports betting, iGaming, esports. That is the hottest sector right in the market. Stocks are making new highs, and so I want you to bring our audience up to date. What Fans has been doing, in 21 right now. You've had a busy month, I know that.
Yeah, so we had a very busy end of year. So for people who don't know, we merged two companies in August of last year. So tons of things happened last year to really set us up well to come into January. So since we've started the year, I mean, the big one for us was closing our most recent financing. So we announced it late last year. And then we announced a $5 million financing. So when we merged the two companies, Ascot and Fans, in August of 2020, we did a $5 million financing. In December, we decided to kind of go back to the market. We announced another $5 million financing, really off the back of what you were just mentioning. We're in a space with major tailwinds. We are positioned well from an infrastructure and setup and technology to take advantage of that. So we decided to put some money in the bank so we could move into 2021 and just get heads down on execution. Anybody who knows raising money takes up a lot of time and headspace for founders and people that really want to run the business. So we wanted to get that out of the way. We announced 5 million. Within a day, we were upsized to 11. So within probably 6 hours, I think, of coming out, raised 13.4. So we're in the process of finishing that off. So that closed on January 11th. So we have the money now in our bank. So Fans is a company well capitalized. We are probably close to 15 million or just over 15 million cash. We have no debt.
That's a great position to be in your space because you can take advantage of a lot of acquisition opportunities. There's a lot of opportunities in the market right now.
Yeah, absolutely.
Scott? Scott? Okay, I think we're having a technical difficulty. Okay. Okay, stand by. What's going on? Scott? Scott? Okay. Stand by. We're look like we may have had an internet connection. Yeah, we got to get Scott back. Hang on. Stand by. Okay. Scott?
Sorry.
Okay, I think we lost you just when you got to the good part. It must be.
Okay, sorry. Yeah, I couldn't tell. I think we're having some internet problems in the building, so I apologize to everybody.
Yeah. Okay, so it's okay. Let's.
Where was I?
I think okay. So we were talking about the upsized capital raise.
Yep.
The deal was oversubscribed 2-to-1, more than 2-to-1, and I was asking you about. Right now there's a lot of opportunities in your space for acquisitions. There's a lot. You got $15 million in cash in the bank. What kind of things can you do with that money?
Yeah. So that's it's a big priority for us right now is M&A, and that's why we want to do it. So coming out of the pandemic, there's I guess some businesses that didn't fare as well. I would say they're in positions where they need cash injections, and we're now I guess ready to take advantage of some of those. So we have made it a priority of our board and ourselves to identify and begin discussions around that. So we've done a couple in the past. So in the short history of FansUnite, which only goes back to March last year, in terms of being a public company, completed 2 major acquisitions. One was McBookie and one was Ascot. So we don't tend to do things small. So we are looking for some significant acquisitions that really beef up the business. And there's a couple of fronts there. One is revenue. So we are actively looking for, again, like what we did with McBookie, is find a very solid business that's got good revenue. It's not going to be a cash burn on the business. So in addition to the cash position, we also have a nice liquid stock out there. So we trade well, we have good volume, and we've been raising the value. So we have those 2 methods of acquiring a business: stock and cash. So nicely positioned there, as you say. And on that 15 million, we have no debt. So, we don't owe anybody any money. We're pretty prudent with our capital and our spending. Both Darius and I, from the fan side, and mine, 7 years of being entrepreneurs and running companies, being fiscally, I guess, conservative and protecting shareholder capital and wealth has been a priority for us. First time we're really in a position to deploy capital at the speed which we're going to be able to. So not only are we looking to double our team size this year, in a short period of time, we're going to be spending money on marketing. So a lot more on the consumer-facing businesses we're going to put money into. So we have McBookie, and then Vamos, which is McBookie is a Scottish-facing UK sportsbook, profitable business for the last 10 years, but has really spent no money on marketing. So we've now got the money for them to spend and really dominate the market they're already in, doing very well. Vamos is a new site we launched to go after the Brazilian market, primarily esports first, but we will be adding sports and casino, so giving them a very healthy marketing budget. So we're really excited to see what we can do on the customer acquisition side as well. So business acquisition, but then also customer acquisition is going to be a lot of the news you see coming out early for us this year. In addition to new licensing, so we're in the UK process, or about to be. Some other things we're going to be doing around the US, which we'll be talking about in the coming weeks. So obviously all that takes money, and now money is not our concern anymore. It's just execution.
Okay, that's okay. So you've had this is so in the last 90 seconds you've made some very important stuff here that you mentioned. Okay, so the takeaway is, with this cash, you're going to actually be able to roll up the consumer-facing brands, Bookie, Vamos. So we're going to start seeing organic growth in those, which obviously got a higher margin, the B2B stuff.
Yeah. It's I mean, obviously there's days and weeks when the customers win, which we need. So in casino and sportsbook, you do want people to win. So there's obviously some ups and downs in terms of revenue on a consumer facing product. But one of the things, when you have capital, we can go after more users. We can incentivize users more through bonusing. And then we can also attract bigger users, because you'll see some sites that aren't capitalized well can't take bigger VIP players because they can't afford to eat some of those losses, because there's going to be some. So that's one of the things we wanted to bring to the table with a McBookie, is to sort of open the gates a bit to bigger players, because that's a requirement of a very big and successful sportsbook if you're consumer facing. So while we appreciate the background they have, which is similar to ours, which is, protect your bank account at all costs and make sure you have enough cash to survive, we can now let McBookie go and really do the marketing. Same with Vamos, and we don't have to be concerned about a large VIP player coming through and us wanting to shut the door because they might win 1 or 2 days. We know the long term of casino sports books. Typically, the house wins.
Okay. So Scott, for anybody that's new, can you just give us a quick snapshot of kind of the FansUnite, like the business model you cover, the whole range from the esports. What are the what are the markets that you're addressing?
Yeah, so FansUnite is now really the parent company of all the other entities. In March of last year, when FansUnite got itself public, it completed its first acquisition of McBookie. So McBookie is a direct-to-consumer sports book in the UK, operating under a white label, which means it's using someone else's software currently, using someone else's gaming license. So that's an operating traditional sports book. In August, Darius and I completed the merge of our two businesses, which was bringing in Ascot Entertainment. Ascot Entertainment was really focused on being the backbone of technology for a full suite of betting and iGaming. So being able to provide any operator around the world with a full platform to launch their own brands. We've used it for our own direct-to-consumer brands, and we were really an esports focused business, Ascot was at the time. So we had shifted in 2014 from traditional sports to going after that huge market of video gamers. If you look at the Twitch numbers, you know, you've talked about it before on this thing, so I don't need to go into the massive size of that audience, how it's growing and how we think it's the future. So with the merge of Fans and Ascot, you know, FansUnite now really has a full technology solution for betting and iGaming, which I consider to be the casino side of the business. We have operations like a McBookie, which is direct to consumer. So we have our B2B, which is the technology side, and then our direct to consumer. Ultimately, we'll control the technology for all of our consumer brands. So as we acquire brands like McBookie, we can leverage our technology so we can wipe out a large chunk of cost for them that they're currently paying. So they'd be paying a monthly fee plus a revenue share forever, and with no caps. So we take advantage of cutting the cost for them, but then capturing more of the revenue for our business. And then the third arm is our game side, Ascot Games. And that's where we're producing our own casino style games with video game and esports themes and content. So again, appealing to an 18 to 30-year-old demographic. And that's kind of what we're after with the whole company is capturing the new sports bettor, the new casino player, capturing the gamers. We're an entertainment product, and we want to entertain that demographic. So it required, I think, a shift in the offering. So we're doing all that. If you look behind that, we've got years of technology building behind us. So we have a scalable infrastructure, architecture, ready to handle 200 to 300, 400, 500 betting sites around the world. We have gaming licenses. So that's a big component of being able to do what we do, is having and operating in regulated markets, which is our focus. So we have multi-gaming licenses, both direct to consumer and business to business. That allows us to address the European market. Through a partnership of software, we control a Curacao license, which gives us flexibility in a number of other markets. We're in the process of going after a UK license, which is considered the gold standard of betting licenses, so a UK GC license. And then we announced a partnership last year for our entry into the US. So we're working with GameCo, who has licenses throughout the US. So really we're a full iGaming betting solution, starting with technology and operating in some regions. We're pretty specific or targeted about which regions we go into on a consumer-facing side. So we don't see ourselves as a direct-to-consumer in the US, for example, but in other markets we do.
Okay, I want to spend some time talking about the US, because I think that's going to be one of the big growth initiatives for 21. I wanted to actually bring up, I think Adam is asking this question, which is, so one of your I think one of the big catalysts, you know, for this year is the casino games you're doing, these RNG games that you're basically you're putting into these aggregators, and they get each, and the aggregators then resell it, or they license it to, you know, hundreds of different, you know, online casinos, and each game, you know, can bring in, you know, you talk about some of the numbers, which are phenomenal. Well, I want to ask you about, you know, to go through those numbers, but Adam is asking about the adoption. What's happening in terms of adoption with those aggregator licenses?
Yeah, so I would say in terms of demand, it's high. So we have a lot of aggregators that are ready to take them on. We had set ourselves a target of having five 4 to 5 games done before we go out to those aggregators. So our 4th game is in testing now, and our 5th one is underway. So our aim was to have 5 done and out the door in Q1 of this year. So we're on track to do that. That's kind of the catalyst for us to go out and do more business development on the aggregator front. So going and acquiring more. I think Adam asked about the ear as well. So that'll be our first adoption measure. And we don't have it yet because we're still completing the first integration with the ear of porting our games into their remote gaming servers. So that's what's going to allow them to push it out to their network of 120 operators. I suspect we're probably in the range of 2 to 3 weeks away from having that done. Our issue is we're ready on the first games, but we're a bit in their development pipeline at the moment. So I think we're just 2 to 3 weeks away from then being able to, I guess, flip the switch with the ear. So we'll be able to update that in the coming weeks. But that's where we're at. We're very close to having 5 games done in Q1, which is the first milestone to go on the business development push. And then ear, we're just a couple of weeks away from being able to turn it on.
Okay. And just, Scott, could just for anybody, again, that's just walk us through kind of the numbers, how that works, how much you can make per game, per month, per casino when it goes into these, aggregators.
Yeah. So, if you get a game it's a hit, and it's all, a lot of it is how the game's promoted and obviously how it plays and if people enjoy it. The way it works with us is we'll put it into an aggregator. And then anybody who's using that aggregator on their betting site or casino site can access our games. Once they do that, there is a guaranteed return to player. So this is same in a brick and mortar casino with a slot machine or any game you play. There's a certain amount that always gets returned to the player. So whether it's, say 95%, so 5% goes to the operator. We share that with the operator, and that number will change. We know from successful games in a month on a site, you're going to be well into the 6 figures of revenue on that game. So we would share that with the operator, and then but it grows exponentially if you have a good game, because with the ear, for example, who's a smaller aggregator in Europe, but they are plugged into 120 casinos. So the revenue you're getting per game gets multiplied by how many casinos the aggregator's in, and then how many you can get to adopt the game. So, we think we've got a pretty unique angle on these games that are going to be picked up well, at least initially. From every talk we've had, we know people are going to try them just because they're struggling to capture the demographic that we think we're addressing with these games, and that's the 18 to 30-year-olds.
Okay. And again, just walk us through the numbers. How much can you make per game, per casino, per month? So a game that's doing well, I would say you're going to make, in the 6 figures, so 100,000 plus. If it's a top, in the top chart game per casino, that's what you could make. We would share that with the operator, but per game, per month, per casino, I think you could be in that range of 100,000. Okay. And then you multiply it out by the number of casinos you can access. Okay. So let's say they have over 100 casinos in their system, the air, and this is just one group, a small one. Let's say you only capture 20% of that market. Let's say you only get 20 casinos on board. You split the revenues, so you're talking about you could be doing a couple $1 million a month in revenue just from that deal. Yeah. And this is licensing, so this goes to the bottom line pretty much. Yeah, once our games are developed, and we're very cost effective at developing our games. Once it's developed, it's bottom line money for the most part. Okay. In theory, so let's say, so in theory, you could be doing, 5 million, 5 million a month in pure profit almost.
Yeah, I mean, it's a great target for us to go after when we scale these games up and get into aggregators. Yeah, for sure.
Okay. No, this is
and anybody who knows the profitability of casino game operators out there right now, well, you can look at, microgamings, NetEnt, the publicly traded ones, make a lot of money.
okay. So I mean, yeah, I was using the number of 20. If you get 20 of these casinos in, each one, you're doing, let's say, I don't know, 5 games for a couple hundred. So I mean, the numbers add up. I mean,
Yeah.
basically, you can pencil this out.
Yeah, I
And
mean,
then,
this, we're always very conservative, but this, internally, we know this could be the biggest revenue generator in the company if we're successful very quickly.
okay. Okay, so Derek is asking a very interesting question. So you're talking about these RNG games, which are kind of, I guess, the spinning things, So he's asking, aren't younger people, which is the younger demo, like people you're going after, aren't they more trusting of sports betting and esports?
Yeah, I mean, there's probably a portion that are. Really, what these games are is complementary to the sports betting and esports business. So we look at our front door as esports betting or sports betting. Once you're in the front door, it's our job to get you to try the RNG and casino style games. One of the things we're doing with the games, and is a priority, not on every game. So some games are pure chance and RNG and feel that way. Other games, we are giving the user some level of not necessarily control, but a feeling of control, but definitely an interaction. So we're requiring the user to do some sort of action in the game that gives them that bit of control. So it takes some of the RNG away. And then in the future, there's combinations of games that are skill/RNG based. So I think you're right where there is sometimes a distrust from casino games. But if you look into the operator and you look behind the scenes,
What I think what he meant, what he really meant was, that again, millennials, Gen Z, whatever, they want more of that interactive. They don't want just pushing a button.
Yeah.
More interactivity, and that's kind of, your games have that interactive element.
Yeah, and that's what we're aiming for, is that. But what we do know from our history, so we go back to esports betting, back to 2014 with our company. And really what we followed was a wave of activity around esports betting activity. And some of the biggest things to come out of that time was skin betting. So that was where people were taking their virtual in-game items, so guns and knives from a video game, and using them to bet. Then you were seeing things like bingo, so skin bingo, other games, crash games where you put your skins into a pot and the value just rises and you pull your skins out before it crashes. Those became some of the most popular things around esports gambling activity. It became not the betting, but it was those other casino style things. So again, the reason why you're seeing bigger gambling companies like a Betway, for example, spending so much time and money on the esports demographic isn't necessarily because esports betting is making them a ton of money today, but what they are seeing is conversion of those users to go to their casino or to play poker or to place a sports bet. Really, I think the holy grail of a customer in our space is to, if you acquire them through betting, is to figure out a way to get them to your casino. Casinos run 24/7. Yeah, and that's why, again, companies that are doing a good job of acquiring an esports fan right now into a traditional betting site are spending more and more in that space, sponsoring esports teams, sponsoring esports events. And I would pretty much bet that it's not necessarily because of the revenue they're making on that activity, it's the other activities they're doing.
Okay, so it's very interesting. So I think we talked about this a couple of times, that what's happening is a lot of the analysts are saying that the esports, I mean, not the the sports betting, everybody's, sports betting, huge thing. But what they're saying is sports betting, the margins are going to become so tight that only way, like a DraftKings, any of these guys are really going to be able to make money is with, the RNG, the casino games, where that's kind of, where they can actually generate and, profit. And that's where, FansUnite with, your products feed into those customers.
Yep.
So
yeah, and really, the move for Ascot as we were looking for our next move, and why we did the Fans merge, was because we wanted to add traditional sports back into our mix. Fans wanted to get a better esports offering, and then we saw there's this hole was the game side, and so we're filling that, because if you are going to spend the money on customer acquisition, you don't want, as much as possible, you don't want people leaving to do that other activity that's around, entertainment with money. So we didn't want to get them again in the door with an esports bet, and then have somebody who also likes soccer and wants to bet on the Euros. You don't want them to leave. Traditional bettor, a serious bettor, is going to already have 4 or 5 accounts, most likely, for different reasons. But we want to give them as much option as possible, not just for our own consumer facing brands, but for our B2B operators. So it was a real requirement as we were looking forward to be able to answer that question. So now, for example, somebody who signs onto our Chameleon platform the coming weeks can turn on 6,000 casino games. So I think most people know that's where the money is in a lot of cases, is if you get them on the casino side.
Really interesting. So big fans, I mean, so you're operating in kind of multiple aspects of the gaming business, between the esports, consumer side, between producing games for other casinos where you do like a revenue split. So it's really, I mean, it's basically it's like a, I think for investors, really, it's a pure play on the whole boom of gaming, esports, everything. It's
we're an online, we're a gambling company. But really based on technology. So, but yeah, we cover every aspect, I think, that somebody's looking for.
Let me ask you before we get into the U.S. side. I've got a couple of people actually asking, how much, I guess, he's asking how much of a benefit gaming bill having for fans.
Yeah, so that the one major benefit is any good news around betting is good news for us, because public markets react well to that. The other good news for us is we operate in highly regulated jurisdictions already, so we're ready to operate in a highly regulated jurisdiction like Canada. The immediate impact from that change to allow single event betting won't impact our business immediately, because of the way the Canadian government has set up online gambling and casinos. We don't operate in Canada, so we don't go in as a consumer brand. We don't allow any of our white labels to go in as a consumer brand into Canada, because we want to be ready to go into Canada when they change. So that change to allow single event betting needs to happen to make it attractive for a sports betting company. Because to go in as a sports betting company and not be able to offer your users the ability to bet on a single match, it's just not a good product. So that will be a great change. The bigger change that we're seeing happening is with the Ontario government to start, who wants to open up betting to outside operators. So that's the one we're watching closely. We think that will come this year as well. We think both things will happen this year. So once Ontario opens up, it means we can now operate in Ontario. We haven't seen the regulations or the planned regulations. We have a sense of them, and I'm quite confident in how we will come out, and it'll be positive for us. So that's the bigger piece of news in terms of an operational impact. And then we know, or we expect, that if we see Ontario make that move, I don't think the other provinces will be too far behind. It's great Ontario is starting. It's our biggest province in Canada. So that's where the impact will really come, is when provinces start to open up to outside operators.
Okay. Let's talk about the big story for next couple months is you're entering the U.S. market. You announced, was it last month? I think it was in December that you're going to be offering sports betting in Colorado, and then you have some other. Let's talk about your growth initiatives for the U.S. market.
Yeah, so that's one that we're moving quicker on than we had expected 4 months ago, probably. Started with the Gameco deal to partner up with Gameco to go after some U.S. operations. Gameco has the licensing coverage for us, so we can just focus on the software. So the first deal we announced was in Colorado with the Skylight Casino. So that's a tribal group that operates Skylight Casino. We are heavy into integration work, getting that ready to go. Our timeline is as soon as possible, hoping that is it'll be before the end of March is the plan. Again, we're going as fast as we can. There's always regulatory hurdles as you go along the way before you can actually launch. So to pinpoint a date is hard. But what I can say from the technical front, everything is on track to where we want it to be for that timeline. So we want to be live. I can't say the name of the site yet. I'll let the Skylight group announce that soon. So yeah, hopefully shortly when we come back on, we will be talking about that site going live. So on top of that, we want to move quicker into other states. So we signed up with OneComply recently, and that's a compliance group that helps streamline the application process throughout the U.S. states. So it's very burdensome to go state by state, which is how you have to do it in the U.S. So with this, we're streamlining our application process. So it's really one portal to do multiple applications. On top of that, we are now going to have a few more things coming. Probably if I'm back next week, I'll probably have 1 or 2 more things we can talk about, specifically U.S. related. But what I will say now is that it's
there's a hint there.
Yeah. And so yeah, we're accelerating our U.S. plans, and I think that's going to be a big part of the business this year. So it's getting some things in place in this as we speak to roll out, and then make a big push for more U.S. business.
Okay, and so the esports, so the deal with Skylight, essentially that will allow really everybody to bet on esports, because it's all, you have online access, anybody, or through an app, or nobody uses computers, it's all over the phone now, right? So what are they going to be able to bet on exactly? What kind of esports, how will it work? And how will you make money with this?
Yeah, so we make money mostly on the software service side. So we get a guaranteed monthly fee to provide the software. And then as we go forward, as it rolls out, there will be additional benefits around revenue side. So as the revenue grows, ultimately, I think most of our revenue will just come from the pure software service side. So we're a guaranteed revenue every month. What they can bet on. So it's one of the things that's critical to us to be in the US and to be allowed, and it's high on Gameco's list and our other partner 10-Star, is we do E6 sanctioned events. So there's the Esports Integrity Coalition, which is a group we've been a member of since the beginning. So they look at the different events that are being offered. So you can bet on professional esports events anywhere around the world. The only ones that will be on our site for Colorado will be the ones that are sanctioned. So we're not doing amateur events that pop up. We're not doing me play you. We're doing professional organized events. So that's really to satisfy regulators, and it's something that we've always thought is the right thing to do anyway. So we'll still expect to see the same 3 games be big in Colorado as they are elsewhere, which is Counter-Strike, Dota 2, League of Legends. Other ones are getting bigger, but if you, I think, go around the world and talk to any betting operator in the space, 80% of their bets are going to be on those events. And it's good because those are the most, I would say, professionally organized events. And they have, if you look at the League of Legends Riot League, so very consistent, great production quality. You know the integrity, you know when it's happening because it's a league system. So it'll be very similar to, a typical hockey season, football season. You'll follow the League of Legends splits. So that's what you'll be able to bet on with the site.
Okay.
And that will be statewide. So you'll be able to bet throughout the entire state. Obviously, you have to be over 18. You have to pass the KYC, which is to know your customer. And you can be a visitor to the state, but you have to be within the state lines when you access the site.
Okay. Yeah, Colorado is a very progressive state.
Yeah.
A lot of things.
Yeah, that's why we chose that one first. There's a lot of other states, even though they're trying to move quickly on sports betting. Not as many are addressing esports yet. So we targeted Colorado for that specific reason.
Okay. So okay, and I'm not sure if I asked this. So Derek is asking, which channel yields the most revenue? Is it the McBookie, the casino that you have?
Today it is, yeah. Today it is. That will change over time, but currently that is our highest revenue generator.
Okay. Let's see. Derek is asking, when is the Q4 numbers coming out?
So we'll be doing our 2020 entire year end, getting prepped for audit. Audit will probably start early March and be released in April.
Okay. Yeah, it looks like a lot of people in the audience are essentially saying they want to see some of the numbers in order for the stock to move up. They want to see kind of the traction. They want to see it actually in black and white. Okay. So with that said, what about do you have any revenue? Can you make revenue projections for 21, or is it too early? Like what's
yeah, I mean, we gave guidance sort of last year, and we've just been sticking to that right now. It was done with the Mackey report. So more than double 2020 is our aim. So we looked at McBookie annualized when we acquired them, and we wanted to double that annualized for 2020, which we did. We want to more than double that again this year, which already I think we're comfortable with that. So our aim is without any additional acquisitions of revenue at this point, we'll be over 5 million. But it is early to say, because I think we will have some acquisitions that give revenue, and then there's a few unknowns that we know are going to generate revenue, but games being one of them. Until we push them out, it's an unknown.
So, but what's going to be the biggest revenue driver in 21? Is it going to be the aggregators? Like, what's going to be the big source? What do you expect to be the big source?
So in those numbers, we kind of went off, again, we're kind of run by a bunch of accountants, and we went off numbers that we know and we're conservative. So we really focused on the consumer revenue, looking at what we know McBookie had done, what we think we can do in the VAMOS, and with the deals we had in the pipe on B2B. And only on the B2B deals, we really looked at the guaranteed monthly revenue, which is the license fee. We didn't really build much in. So still the bulk of that revenue and where we're comfortable is around building off of numbers we know. Where we didn't really put much into is upside on casino games. So we're not dependent on those for that revenue number. We're also not really building in anything on any of our B2B sites taking off. But because we do a revenue share with them, if that happens, both of those could blow our numbers out, kind of out of the water.
Yeah, because basically, okay, so these numbers that you're talking about right now, I mean, again, these are very conservative numbers. It's just based on the fixed. It's not based on, the upside, the licensing.
Yeah, we moved away from the the early stage startup pitch deck where everything's like that.
That's what it could be in 4 or 5 months.
Yeah, I mean, we had a more than doubling this year. We have a doubling or tripling the year after that. And we're we're a low burn bit company for what we do and the revenue potential. We're a very low burn company, so it is a good path to profitability for us and cash flow positive, which is again always something we look to be.
Okay. We got a question about how much cash reserves do you need to have on hand to pay off potentially big wins in your consumer platforms?
I don't have a number in mind. I just know we have more than enough, much more than enough now.
I mean, it's a regulated. You have to have a certain amount, right? It's all regulated. The amounts you have to have.
We don't have to. So the way we work with McBookie and the way a lot of people work, because they're a white label and because they have a data provider, a lot of people will work off of a managed trading service. And a managed trading service is really your backstop. So what you do there is you can set loss limits, and they manage your risk. So you're never on the hook. If you have a losing month, that loss will carry over into your next month's revenue share portion. So as a requirement from a regulator, when we're using a service like that, we're not required to have a reserve on hand. What we are required to have.
So it's, in other words, they're like, it's like an insurance service you're paying for.
Yeah, I mean, they provide us a bit of insurance feeling or coverage, or knowing that we're never going to be in a position where we can't pay out, because we have stop losses in there, and we're very proactive on risk management. So we have traders and full operational team that watches numbers 24/7 to see what's happening. And then really you're relying on your provider. The reason lines move in sports betting is to manage that, right? So you're always trying to balance the book. So we spend a lot of time deciding on who we're going to work with to make sure that they're very good at doing that. Because that's, if they're not good at that, then there is more loss potential. But really that's how you'll operate, is with a managed trading service who helps us do that. Because we own our technology, we have another layer on top where our own trading team can override and change things. So McBookie, for example, for marketing, we want to be the best odds on Scottish football/soccer all the time. So we have the ability to do that. So we can take in a managed trading fee, but then change and adjust for what we want to do, whether it's marketing purposes or if we have a different, sense of risk. We also categorize players. So you can watch player activity based on the, if they're a sharp person or whatever, you can watch that. So we're not required to keep a reserve for that reason. What we are required to do is keep a player protected fund balance. So that's where we have to be able to show every day that we have enough money. If every player came to us to withdraw, we need to have enough money in the bank to pay them. That's fallout from the probably the old poker days, when before the poker crackdown, when the government came in the US and shut down a bunch of sites and realized that a lot of those guys were using player money for things that they shouldn't have been. So we're in jurisdictions where that's a requirement. So players with us know that their wallet balance is always protected. And we have to report that in most jurisdictions probably on a daily basis.
Okay. This is a good question here. So, the business unit is very competitive, especially, the B2B side. So what is your competitive advantage to gain more customers in B2B?
Yeah, I think because we're a newer company in this space. We've come at it from a kind of a millennial generation aspect of looking for building products that appeal to that. So most of the people we're competing with have been around decades or more, and are struggling, I think, to turn that ship to do that, which is to build things like our stream betting products, like our casino game products. So we have that advantage. I think the other one we have, or we know we do have, a cost advantage, because we are a low cost group, and so we can compete on cost if we need to. But I think in flexibility of platform, esports first focus, casino games, I think we've got a better offering to get the 18 to 30-year-olds in the door, and that's really why people are coming to us. We've done no business development yet, so anything we've done to date is people are coming to us. Gameco came to us. Any white label we've had in the past has come to us. So we haven't had a chance to go do the business development yet. So we just know from people finding us.
So it's a whole untapped market opportunity, really. I mean, you really haven't scratched the surface even.
100%. We're going to add business development people. We still haven't done it yet. Like I said, we have so much on our plate right now.
everything, all the business you have is just, it's all just stuff that's just came in over the transit, just whatever people they found. Okay.
Yeah.
Excellent.
I'm gonna have to hop off here in about 2 minutes.
Okay, last, we're gonna wrap up here. Brian is asking, does McBookie take bets on horse racing?
Absolutely, they love horse racing there. It's a big market for them. So, and we're about to improve their horse racing offering quite significantly. So, if you love horse race betting and you happen to be in the UK, check it out.
Okay, Scott, 2 last questions. What else? What else can we expect in the coming month in terms of news flow?
Yeah, I think we'll have some stuff around licensing. US are going to be big ones, and then game launch. So we'll be back to show our next game, and then tell you when they go live.
Okay, so new game, something we haven't seen yet.
Yeah.
Okay, licensing. Okay, so it looks like you're gonna have a lot of news flow this month, a lot of positive developments. Scott, let's wrap up. Last question, our favorite question. In your opinion, top 3 reasons why investors should consider FansUnite right now.
Yeah, I think I always start with our team, the technology, and then just the momentum. We have so much momentum coming off of the financing. We've never had the runway to execute, I think, like the way we can right now. So tons of big things this year for us.
Okay, excellent. Scott, on that note, thank you, and we'll look forward to hearing more from you and Darius in the coming weeks.
Yeah, hopefully we can come back next week.
Fantastic. Okay, thank you everybody for joining us. See you on the next live stream.
Thank you.